The global stock markets are going up again and are reaching new highs. It seems like the markets are leaving the worries of the pandemic behind them and are again going full speed. Too soon, perhaps? What's up everyone, my name is Joris, welcome back to my finance channel. The International Monetary Fund, the IMF, just released their findings on the global economy and the results are pretty surprising. It looks like almost every country in the world is leaving the problems of 2020 behind them and they are set to grow economically over 2021. With the end of the pandemic in sight, the world economy is recovering faster than expected, mainly because of the major stimulus plans, the stimulus packages in some of the big economic countries and their vaccination programs. The International Monetary Fund adjusts its global growth outlook for 2021 from 5.5% to 6% and for 2022 from 4.2% to 4.4%. According to Reuters, the expected growth for 2021 has never been this high since 1976 and it will compensate the economy decline of last year completely. Over 2020, the global economy declined only by 3.3%. It was expected to be a lot worse. The decline was limited by the numerous stimulus plans of the major economies. Without them, the decline would have been at least 3 times as bad. Worldwide stimulus packages are calculated to be around $16,000 trillion. Unfortunately, however, this all is on a global scale. There are huge differences between all countries. The United States, for example, they are issuing a lot more financial support to their economy than the European Union is doing. And as a result, the American economy is recuperating at a way faster rate than the European one. The International Monetary Fund expects a 6.4% growth in the United States economy and only a 4.4% growth in Europe, even though the American economy declined less than the European in 2020. Belgium is performing under average with only a 4% expected growth over 2021. Geeta Gopinath, head of the economy of the International Monetary Fund, notes that the recovery is not evenly distributed. Some countries are recovering faster and earlier, while others are lagging behind. China has already recovered in 2020 and is expected to continue its growth over the next few years. The United States will reach their previous gross national product in 2021, while many other developed countries will reach this threshold in 2022. And most of the third world countries, the growth countries, will only reach this previous level in 2023 or even after. It is clear that the growth countries and the third world countries are way worse off than the rest of the world, often because they lack the financial strength to hand out a financial stimulus. They simply don't have access to the vaccinations, again because of the lack of funds. Furthermore, the main source of their income is tourism, and that has completely dried up in 2020. So again, not much funding there. This recovery in different speeds will deepen the gap between wealthy and poor. The poorer countries are not able to finance the growth and recovery, while the rich countries can push the economy in the right way by financial support. On an individual level, this is true as well. Young people, the younger generation or lower educated workers are often hit harder during the pandemic, losing their jobs and are not able to find any new ones. The International Monetary Fund notes that in 2020, 95 million people extra ended up in poverty. And this does not only occur in third world countries. Even here in Europe and in the United States, people have lost their jobs and they still had to pay their monthly mortgages and monthly bills. I think the pandemic and the financial problems have made people a lot more defensive about their spending habits, especially those who have lost their jobs. On a personal level, I can see that a lot of real estate has recently been sold by people who were not able to keep up with the mortgage payments and they were forced to sell their properties. A lot of people my age also decide to rent instead of buy. In Belgium, around 29% of people rent their place to live, while all the others are owners. This percentage used to be just 25% a few years ago, but because of the pandemic we see a swift shift in this home ownership over time. In the future, real estate will be focused in a smaller group of people and the share of renters will continue to grow. If you compare that to other European countries, they have about 50% renters. So here in Belgium there is still a lot of room for change. The younger generation does not want to be tied up to a real estate investment for a longer period of time. They want to be flexible and they want to move out whenever they want to. Not having a huge mortgage above their heads is also a major plus. But they're never really building something up. If you rent, it might be because you don't want to buy a property or you're simply not able to buy one. Anyway, please set up a savings plan and an emergency fund and also start investing whenever you can. We saw last year that creating your own personal safety net is crucial to staying afloat during an unexpected crisis. Since the stock market is now assuming that the worst is behind us, stock prices are going up again swiftly. A worldwide economic growth of 6% is huge, and it will support the stock market over time. As we saw in the last year, people who invest have multiple sources of income and they also have money handy for a rainy day. Those are the people that got out of the pandemic relatively unscathed. But those who do not have a plan or have no opportunities, they have it bad. And it will take some time for them to recover and catch up. That is, if they are ever able to catch up. People often ask me if this is a good time to invest and if they shouldn't wait for the next crash. Well, as you can see, the economy is expected to grow in 2021 and it is expected to continue to grow over the next years. So do you believe this as well? Then get to investing. Time in the market will always beat timing the market. The International Monetary Fund further noted that the stock market has risen aggressively since New Year and that it is currently overvaluated. This is because values are calculated on current business valuations, still in the pandemic period. Is the stock market overvalued? At this moment in time, yes. But the stock market is already looking at the post-pandemic pricings. This means that if the pandemic is conquered soon, the economy will thrive again and the current valuations are viable. But if it takes longer than expected, we might see a dip in the markets soon. As we can see that the United States are very far progressed in their vaccination program, we can assume that this rate of vaccinations will continue and that there is a light at the end of this dark tunnel. Jamie Dimon, the CEO of JP Morgan Chase, is optimistic about the economic recovery, in particularly the American economy. He notes the surplus in savings, the major stimulus of the government and central banks, and the successful vaccination campaign will support the economy greatly. He expects the growth in the stock market can continue to run far into 2023. He also points out the Goldilocks moment in the stock market. Great economic growth and slightly growing inflation. Both together form a very good support to the stock market. If you've enjoyed this video, share it with your friends, break the finance taboo, start talking about money and share your points of view in the comments below. Leave a like on this video and subscribe to my channel. Your support is greatly appreciated. I will see you in the next video.